Now, the first wow about this topic I'm going to show you right now is that who knew we'd get rid of the bad stuff and the good stuff would be tax stuff. That's a wow. Next wow on this is it works for everybody in this room. It doesn't matter what color workbook you have. Purple, single people, green, married. It works for everybody in here. The only thing is, though, for married people, it's more than a double whammy. It is more than doubly amazing for married people. In fact, this is a wow, and this is no lie. We have had single people get married just on the strength of this new knowledge. It's that powerful. In fact, we've thought about converting our evening workshops into little mixers. Put the purple book people over on one side, and we maybe give them a little wine to get it going and stuff, and we go, okay, purple people, here's what you got to do. You got to look for somebody much older than you. And hey, used to be limited to opposite sex. The Supreme Court doesn't care about that anymore. But we'd also recommend, hey, look for somebody while you're at it with a big giant number ovalized on the back of their blue book, and then, hey, maybe we get like 2% and everybody's good. No, it works for everybody. Amazing for married people, but it works, like I said, for everybody. And it's another path down my discussion, my theme here, forms of ownership, right? Now, we hammer joint tenancy pretty hard. That's the default form of ownership that our system herds married people into. But now, we're going to introduce a new form of ownership that we can take advantage of just by luck in that we live in one of these states, and there's only 9 of them, where we can play this game. Because California is one of the 9 so-called community property states. Okay, now, we understand, we acknowledge, community property does have a little image problem, and it's derived largely from the divorce side of things, because we always hear these horror stories, oh, stupid community property, lost half of everything, hate these rules. Here's another thing, another reason we love what we do as estate planning attorneys. We know for a fact we're some of the only lawyers out there that have actually happy people for clients. If you think about our legal system, most people, when they're interacting with a lawyer, it's not something good. It's negative, all right? And therefore, the lawyer is surrounded by that negativity. And the weird thing about our system is, okay, let's say you're getting sued. You've got to go to a lawyer. Well, that's not a great interaction between the client and the lawyer. Or what about even if you're suing somebody? Even that's not a great interaction, because why should you have to sue somebody to get something you shouldn't have had to sue for? And I don't know how those divorce attorneys handle it, because there's just so much negativity surrounding them all the day. And then our system is such that that attorney who's surrounded by their client's negative baggage is going to go to war with an attorney on the other side who's in the same boat. They got somebody that's surrounded by negativity. It's just a downward spiral of negativity. Not us. Our clients are happy because you're finally getting around to doing something in the back of your mind you've known for a long time you got to get around to. It's just an awesome feeling, a peace of mind to get it done. Check it off the list, okay? And another thing that's positive about our world is that these rules and presumptions that govern this whole community property thing that sometimes lead to seemingly inequitable results in the divorce side of things, in our world of estate planning, these same rules and presumptions lead to amazing outcomes, okay? So, now, Caroline, we're back, all right? Yeah, that little interlude with conservatorship, dude? We're back, okay. All right, and so Carol and I are a married couple in California, and let's say we decide we want to buy something, okay? It doesn't matter what it is. It could be a house we're going to live in, a rental property, a racehorse, a bar of gold, a share of stock, who cares? We buy an asset. Now, I'm going to do a little illustration up here with a little bit of light math, okay? Because like I said, we're not math guys, so the math will be super simple. And I'm going to use the simplest asset I can think of to give this little thing some life. We're just going to use a piece of paper, a share of stock, okay? But now, I'm going to use simple asset and simple math. You guys aren't bound by that. You can follow along in your head with any asset you want, okay? And the numbers can be as big and crazy as you want, because this technique works on all kinds of assets and there's no limit, okay, to how big the numbers can be. All right, but we're going to buy a share of stock. And let's say Caroline and I buy this share of stock and it costs us $100. That $100 purchase price is what the IRS calls our basis. Basis. That's one of those words we thought we knew what it meant until the IRS got a hold of it and they gave it a new definition. And in IRS speak, basis you can kind of think of as like your purchase price, what you paid for something. Okay? Now, if we pay $100 for that thing, that means in theory, each of us has a $50 theoretical interest in it. Right? Okay, so husband's got 50, wife's got 50, you got a $100 share of stock. Now, let's say that share of stock that we paid $100 for goes up in value to a fair market value of, let's say, $1,000. That'd be a wow. All right, now we got a $1,000 share of stock. That means in theory that husband and wife each enjoy a theoretical $500 interest in that $1,000 asset. Right? Okay, so we bought it for $100, goes up to $1,000, and we say, hey, let's cash out, let's sell it. And we do sell that share of stock for $1,000. We got $1,000, right? For how long? 2 heartbeats or something? Because here they come. Here come the governments knocking at our door. All right, and they're going to tax us on this transaction. And what are the taxes? How are they going to get to that point? Well, all right. In order to get to the taxes, they have to come up with this thing they call our capital gain. All right, and that is an easy calculation because all you do is you subtract your basis from the fair market value you sold it for, you know, what your purchase price versus your selling price. So we got 1,000 minus 100 for a capital gain of $900, right? And it's that $900 capital gain that we're going to pay taxes on. And what are the taxes? Well, we got 2 entities, right? We got the federal guys and the state guys. And before we get to what the tax rates are for those 2 entities, I got to add in 2 more little assumptions in case we got any CPA or ringer types in here looking to nail me on some little technicality. Let's first of all assume we owned it for at least a year. So it's what we call a long-term capital gain. All right. And then the second assumption we're going to add in here is a little bit newer. It came about as a result of the resolution of that fiscal cliff thing we had a few years ago. I remember, I think it was 2013, we had that fiscal cliff. And one of the things they did in terms of getting us back from the brink was they messed around with the long-term capital gains tax rate at the federal level, but only for like the high-flying 1%ers. So let's make a reasonable assumption that we're all members of the 99% club here, okay? And so for us, those federal numbers didn't change. So we've got 2 entities, right? So how much of that capital gain are we going to send to the guys back east? We're going to send them 15%, okay? And then how much are we going to send to the guys up north? We don't have a capital gains tax per se in California. They just lump in your capital gains. They treat it like ordinary income. So it's just you pay your income tax rate of California on capital gains and anything else. And what's our tax rate here? Well, that varies between maybe like 8% and 13%. So let's just take a nice round number in the middle. Let's say 10%. Okay? So we've got 15 going back east, 10% going up north. So we're talking about somewhere, you guys, in the neighborhood of plus or minus a couple percents here or there. 25% of that capital gain we're going to give back to the governments in the form of their taxes. Okay? All right, now, that was the analysis if we bought it and sold it while we were both alive. Now, Caroline, honey, little piece of bad news. One of us is going to take a little trip from here to over here. Let me guess who you think that should be. How did I know you were going to say me, Diane, all right? Wow. All right. Well, you're in luck because I always do. It's more chivalrous. It's more statistically likely. But it doesn't matter. Could have been me. Could have been you. I'm going to let you live, though. All right? So I die. I take one for the team. I do it all the time. All right? So I die. Caroline lives. Now, we're going to do a little compare and contrast game here with these 2 forms of ownership that I've introduced into the conversation, right? Our old not-so-good default form of ownership, joint tenancy, and our new, soon-to-be-good buddy here, community property. Now, to keep the playing field level during our little compare and contrast game, let's assume for the sake of argument that at the time of my death, the share of stock was worth $1,000 under each of these 2 ownership scenarios, right? 100 here, 1,000 here. And let's do joint tenancy first, the default form of ownership. Now, we bought it for 100, went up to 1,000, and I die. Now, nothing in Caroline's world fiscally has really changed in general, but specifically with respect to her $50 theoretical interest in that basis, right? That never changed. So that gets carried over here. In fact, in a really rare moment of lucidity, the IRS actually calls that her carryover basis. It's carried over. Her basis gets carried over. But now, remember joint tenancy, that right of survivorship, that mythical notion? Oh, if dad died, flows to mom, therefore, well, we know about the therefore, it goes into probate and all of that stuff. But it does flow from me to her through that right of survivorship when I die. But what flows? It was worth $1,000. At the moment of my death, I enjoyed a $500 theoretical interest in that thing for tax purposes. So for tax purposes, that's what she inherits from me through that right of survivorship. So that $500 part that I had is brought down here, added to her carryover basis to come up with a value that the IRS calls her adjusted basis. Adjusted basis of $550. Everybody with me on that? Okay. So we bought it for 100. It went up to 1,000. Settles joint tenancy. And she decides she wants to sell it the day after I die. So she does. And she sells it for $1,000. And she's got $1,000, right? For those same 2 heartbeats, right? Because here they come again, knocking at her door. They're going to want to collect their taxes. And they're going to calculate the taxable gain the same way they did before by subtracting her basis from what she sold it for. Only this time, they're not dealing with this original $100 basis. They're dealing with her adjusted basis of $550. So this time she's going to pay tax on $1,000 minus $550, or how much? $450. Well, that's weird. Because all you guys are all locked in like 20 minutes ago. You might recall. Remember when I completed my total destruction of that stupid method of adding a kid on as a joint tenant, and we said, okay, it's a disaster for the kids, a potential disaster for the golden child. Most of all, we're exposing everything we own to ridiculous risk. If you remember at the very end of that, I wrapped that whole thing up by saying the real irony of joint tenancy, the default form of ownership, is that even between spouses, it leads to a crappy tax outcome we're going to get to later on up here. Well, now's later on, and we're up here, and you're looking at that, and you're going, wait a second. Caroline's paying tax on $450 instead of $900. That's approximately half as much tax. It's a little joke, you guys. It's exactly half. Okay, $450, $900. All right, but you're going, she's paying less tax. She's paying on $450 instead of $900. What's so crappy about that? Well, it was really crappy for me, right? I had to take one for the team to make it happen. But hey, part of what we deliver in our profession, I guess, is silver linings. Or maybe, for all I know, especially today, maybe it's a win-win for her. Who knows, whatever. But anyway, okay, she gets a better tax outcome. She sells it. She pays tax on less, right? Okay, that was joint tenancy. But now let's just say, for the sake of argument, that two little words on that share certificate or deed to the house or whatever you guys are following along with in your head were different. And instead of it saying husband and wife as joint tenants, the default words, it said something different that we have as an option available to us as Californians, okay? But keep in mind, just because we have this community property option available to us doesn't mean that anything we own for these purposes is automatically community property. It's not. You have to ask for it. You got to opt into it. But let's say we had, and let's say that share certificate didn't say husband and wife as joint tenants, but rather it said husband and wife as community property. Now we're going to do that same analysis, and you guys are going to see that there's two amazing differences in outcome. The first amazing difference in outcome, it just comes about as a result of the application of tax law. And you guys know the deal with tax law, especially this time of year, we're all up to speed on it, right? There's no logic to it. It's just rules driven, okay? But this little bit of tax law, you're going to want to think of as tax magic. Because if that thing had been titled as husband and wife as community property, by operation of tax law magic, at the moment of my death, her basis just magically gets what they call stepped up. And what that means is her basis just magically becomes whatever the thing was worth at the moment of my death. So this time, we bought it for $100, goes up to $1,000, I die, she decides she wants to sell it, all right? She sells it for $1,000. She's got $1,000. She says, hey, come on in, tax guys, and calculate away. Because she knows when they go doing that capital gain calculation, they're going to do it the same way they did before by subtracting her basis from the fair market value she sold it for. Only this time, they're not dealing with some little wimpy adjusted basis. They're dealing with a fully robust stepped up basis. So this time she's going to pay tax on $1,000 minus $1,000, or how much?
0.
Big fat red zero, right? Doesn't that deserve something else too?
Wow.
A wow? I had to, you're just speechless? That was really weak. I had to grovel to get that? You guys are just speechless. I get it. Okay. All right. That's not a little less. That's not stretched out or picked up by the kids some other generation. That's eliminated. That's wiped out forever. It's gone. That's a wow. Okay? But now, all you speechless people, I'm going to give you a second chance. Because remember I said this works for everybody in here, and all you purple book single people, you can get this tax treatment once through your properly prepared estate planning documents. But you remember I said it's more than a double whammy for married people? What did I mean? Here's what. Because, okay, bought it for $100, went up to $1,000, I die. Caroline could have sold it. She could have sold it for $1,000 and she would have paid that much tax. But she's not the selling type. She's the buy and hold type. So, between that time when I die, was worth $1,000, could have sold it, paid no tax, and the intervening time between then and when rule number 1 finally catches up with her, let's say it had gone up in value some more to, I don't know, $11,000. Guess what? This little tax phenomenon is known as the double step up in basis, so that when she dies, it happens again. So now, those kids over there, they're going to inherit this share of stock that's now worth $11,000 that way back in the day we paid $100 for. They can sell it for $11,000, and that's how much capital gains tax they're going to pay. That's a wow. All right. What? Nobody has parents? Okay. That's a wow. All right. Look, and that's incredible, right? That's not a little less. That's not stretched out. That's not picked up by the kids later on. All right. So that's amazing difference in outcome number one. It's the wow. But I said there were two amazing differences in outcome. What's the second amazing difference in outcome? It's the catch. Dang it. Get the lawyers and the tax guys involved. Always a catch. What's the catch? All right. Well, we know now it leads to an infinitely better tax outcome, right? Because paying tax on zero is infinitely better than anything, right? But okay, remember joint tenancy? That whole thing about, oh, gee, that was easy when dad died, therefore, well, we know about the therefore. But at least on that first death, joint tenancy did have the decency of making everything pretty smooth. It did just float them on. Okay? Now, community property, we know, gives us this way more awesome tax treatment once if we're single or twice if we're married. What's the catch? The catch is that community property titling triggers a probate proceeding on death of the first spouse. So after I die, before she can sell it, she has to go through a probate process to get my name scrubbed off of it to get it in her name only. Dang it. If only there's a way to avoid probate. Anybody got any big ideas? The trust. Okay, right. I told you guys before. What's the right way to own stuff? You don't want to own it either of these old school ways, right? You want to own it in your trust. So, we're going to write trust there. We're going to show our little tab 4 document to our stockbroker or escrow person or whatever. And we're going to say we want to take title to that asset in our trust. Well, great. Now I wrote trust there, and by writing trust there, we have now successfully defeated probate on both my death and ultimately on her death. But for me to write trust there, I had to erase community property. Well, we all know impliedly we can only own things one way at a time, right? But we're all fundamentally greedy people in a good way, especially this time of year, about beating our friends at Internal Revenue, right? We would love to have our cake and eat it too, right? We would love to have the probate avoidance on both deaths that the trust delivers, but we'd really love to tap into that awesome tax treatment once over single and twice over married. So how are we going to do that? Is that what you guys are asking? Mm-hmm. Good question. Guess how? No. We haven't run out of documents yet. We got another one. Look at tab 8. Okay? Very boring, mundane name. It's just called Community Property Agreement. And it's probably the shortest document in there because it's mostly double spaced and it's only 3 pages. But what I always say is pound for pound, word for word, that's the toughest fighter in that book money-wise, because what that little 3-pager is saying in essence is, Dear IRS, Dear Franchise Tax Board, for the purposes of tax analysis on death only, none of that creepy divorce stuff, but for tax analysis on death only, treat every asset that's been titled in the name of this trust as if it had been titled as community property. And then we get the best of both worlds. We get the probate avoidance on both deaths that the trust delivers, and we get this awesome tax treatment once if we're single or twice if we're married.
Wow.
What? All right, that's borderline groveling, you guys. When I go like this, that's kind of like a grovel. All right, well, okay, for any of you speechless hangers-on, I got more. This is like my ShamWow thing. One more shot, because there's more, all right? Because Caroline, bless her heart, she's a little high maintenance, all right? So, how did I know? All right, so we go on vacation to Hawaii. And she's hammering me going, oh man, we got to buy a condo on the beach here in Maui. Or we go to Oregon. Oh, must have a cabin up here in Bend, Oregon by Bachelor or something. Or God forbid we go to New York. And she's like, oh, we got to buy a co-op on the top floor of one of these big buildings. And I'm like, well, all right, New York or Oregon or Hawaii, those are not community property states. Okay? You can't own stuff this way there. Okay? It's not a concept they can get their head around. All right? But all we got to do is remember to take our little tab 4 document with us, give it to Lalani, the escrow agent over there in Maui, and we're going to tell her we want to take title how? In our trust. And then guess what? When we die, we're getting that tax treatment on that Hawaiian asset, even though none of the locals over there are entitled to it. You know why? Because we're Californians, God's chosen people, all right? But we're not just any Californians, you guys. We're Californians with a... No. We're Californians with a clue. We learned what that stupid conveyor belt system had in store for everybody else. We said, hey, that system, great for everybody else's, but not me, man. No way. I'm way more clued in. I'm opting out. I'm stepping off of that thing. And that's what I mean. It's not the trust that got us that. It was the trust plus tab 8, right? It's not the trust that solved his conservatorship riddle, right? It was the trust plus tabs 5 and 6, right? So it's not any of the documents standing alone. It's all of them working together as part of your comprehensive integrated plan. They create a synergistic effect, okay? They're more powerful together than any of them standing alone, all right? And it didn't take that much. We just got clued in. And you know what's really cool? This exercise is primarily designed to defeat probate and conservatorship, bad outcomes. But when it's done right, you can drag something like that along with it that comes along for the ride. That's super powerful. That's awesome. Okay, now, at the beginning of this thing, I told you none of what we're going to talk about is that complicated. This is about as close as we get to complicated. There's some math up there, right? And I told you before, it's not secret. This isn't a secret of the rich people. This is a technique of the rich people. This explains how rich people never pay capital gains tax on anything, right? They buy it low, they put it in their trust and wait around. Well, guess what's going to happen? Rule number one is going to take somebody down eventually, all right? And when it does, the survivor could sell it, but they don't have to pay any tax. But they don't have to sell it. They could leave it in their trust and wait around, and then guess what's going to happen? Rule number one's eventually going to catch up with them. And then the kids inherit with a stepped-up basis again. Kids could sell it, pay no tax, but the kids don't have to sell it. They inherit with a stepped-up basis. They put it in their trust, and it starts all over again. This is like the ultimate reset button for capital gains. Remember that 1031 exchange craze that was really popular 10 or 20 years ago? There was a problem with that. You start out with a low value property, right? And then you keep trading up. The catch was you had to drag the value, the basis from that low property along with you. Thereby you're increasing your spread between the basis and the value of the subsequent properties. And plus the rentals, you're depreciating it, the spread's getting bigger and bigger. This is the escape hatch. This shows how to get out of that. It's super powerful, all right? So I said it's not complicated, it's definitely not secret. And I know we got some conspiracy buffs in here and you're going, wait a second. That is a big giant red circle, man. The government's leaving tons of money on the table. You know, they're doing tax, if they're going to shut all these loopholes down, they're balancing the budget and everything, they're going to shut this stuff down. This isn't going away anytime soon. All right, there's two reasons why. They're both kind of cynical. And it doesn't matter what administration's in power. This isn't a political rant. This isn't going away, number one, because how many of you guys knew about this when you came in here today? How are you supposed to take advantage of it if you don't know about it, right? And you remember when I said you would be rewarded in the form of the knowledge you gained for showing the motivation you showed and getting out the door and getting here today? This is what we're talking about, okay? It wasn't the government that was poised to leave all that money on the table. It was you guys, all right? And if a few, the second, even more cynical reason why this isn't going away anytime soon is what? Because they got to leave it open for themselves, okay? They're not shutting it down because for us, these are relatively small numbers. For those guys, that's huge. They're not going to shut this thing down. It's not going away. It's super powerful, all right? Okay, so not complicated, not secret. Now, let me ask you the last trick question I asked of the morning here. What was the most expensive thing you possessed when you came in here today? Nobody say your wife. Okay, the whole wife as chattel thing went out a long time ago, all right? No, it's not your house. It's not your Lamborghini. It's ignorance. Not knowing was setting you guys up to blow a whole bunch of money, all right? Now, if we do our job right, like I guaranteed we would, and we wipe away that ignorance, all right, we educate you about this stuff, yet you still fail to act on that newfound knowledge, that's no longer ignorance. What's that? That's stupid, and we don't have a cure for stupid, all right? All right, so now, I told you at the beginning of this thing too, I said, hey, listen, we understand there's a reason for people procrastinating this. It's because you didn't really know what it was all about. How are you supposed to be expected to move on something you don't understand? Okay, so our job is educating. But now, even after we break through and we coach you up on this and you understand it, people will persist in procrastinating, but you run out of reasons because that one reason's now gone. But people will do what? They'll start lobbing out excuses as to why they're going to continue to procrastinate. And what's the number one excuse people throw out there? They go, oh man, this sounds like it's going to be a hassle. They're going to ask me all these questions and paperwork and statements and it's intrusive. It's going to be a nightmare. It's going to be a hard project to do. Well, let's see how hard it is to do when we do it the right way, the way we do it. All right?